Welcome back to the Know Your Numbers REI podcast. My guest today is a man by the name of Mr. Daniel Kaminski. He has founded the company Foundation Launch after also being involved with a company, Better Wealth, where he and a good friend of both of ours were focused on making people's lives easier by making the way they manage money the most efficient way possible. And that has allowed him the opportunity to go off into this new industry. So I'm excited to share his wisdom and knowledge with you. Daniel, welcome. And if you will, just give a brief introduction about who you are, what you've been through, and what you got going on now.
Thanks, Chris. It's an honor to be on here and to just give some people quick context, because sometimes I'll get into the long story longer. In 2017, we started a company called Better Wealth, and the idea was to be a virtual financial planning company. And, at that time we were still really young and it was pre-COVID. So like doing business on the internet, especially financially, was kind of a new thing. Yeah. And then of course, COVID happened, people are working remotely, and the same financial advisors that were saying we were crazy were like, hey, how can we do business online? And so as we grew the business and as we were trying to figure out our own tax situation, we just started looking at different strategies. And I'm the type of person where I want to know how the watch works. I don't want to just tell time. And so, I'm diving in, trying to learn as much as I can. And one of the strategies that we learned about was the private family foundation. And we actually this was back in 2019, we went to a workshop specifically to private foundations. And it caught my attention because of this concept that I now call a sustainable giving system, which we can get into later. But the idea was that if I just redirected my giving to a charity that I control, and I can grow that and give from the investment income, then my giving can happen whether I'm here or not, or whether I add another dollar into the system or not. So that was my aha moment. But one of the challenges through that was every time we asked a question to the person that was presenting, they would look up at the ceiling and say, I think you can do that.
Yeah, right.
And that just goes against my mentality of like, I want to know, like, is this the right way to do it? Or is it the wrong way to do it? Or is there no way to do it? Mm-hmm. And so I just started researching as much as I could and buying every book I could find, which, spoiler alert, there's not that many books on the subject of private foundations. And I actually went out and became an enrolled agent. So don't quite have the CPA status, but I have the enrolled agent status, and which is the specific designation for taxes, just because, again, I wanted to know like the inner workings. The foundation has a specific 990 PF tax return. And so I wanted to get into that. But through that process, I just ended up being something that I talked about a lot, of the concept of a foundation and why now my wife and I have our foundation and how we intended to use it. And so I have friends and business associates that were like, oh, that's really interesting. It's something I'd be interested in. Who should I go to do that? And quite honestly, the answer is I don't know. Yeah. Because if you go look out for people that offer private foundations, typically they say you need to have tens of millions of dollars, and it's going to cost $50,000 a year to administer. And there's all these traps and all these excise taxes and all this complexity, and they make it sound really scary. But yet intuitively, it's like if you're shopping for a new car and you see that new car everywhere, or that type of car everywhere. The same is true with the foundations. Is like once you start thinking and looking into the world of foundations, you start realizing there's foundations everywhere. Mm-hmm. And it can be a little confusing because there's almost 2 million charities in the country, and a lot of them have foundation in the name. But what we're talking about is specifically the private foundation. And there's only about 100,000 of them in the country. So there's a very niche area of the 501c3. But again, getting into that long story longer, going through this process of having people ask that question, I was like, well, honestly, I don't even know where I would go to get mine set up.
Right.
And so that's where I went through the process and did all the learning, from the setting up the articles of incorporation to the bylaws to applying for the tax exempt status and all the components to make it work, which essentially I built a business plan of like how I could, a blueprint of how I could do this for other people. And that's really where the start for Foundation Launch came from. Was as great as, I appreciate people like you that, do taxes for people. And I tried to go that route because it just made sense to package that all together. Mm-hmm. But for me, being able to focus in just on the foundations and be able to help people be more generous and quite literally help them give their money away is a completely different avenue than helping them accumulate or save money on taxes and things like that, even though there's a component of that within the foundation, but it's specific to that. And so that's where Foundation Launch came from, was, as the name implies, I help people set up foundations, but in my opinion, most importantly, help them manage and effectively use their foundations, because that's where a lot of the relationships start and stop. Is whether it's an accountant or an attorney or a financial advisor, they say, hey, a foundation could be a good tool for you. Right. And they set that up, but then they don't have any ongoing support. And that's where a lot of foundations go dormant, simply because they don't quite know how to use them effectively.
Yeah. No, that's so good. And I love hearing the stories of where you've been, because it's like you guys started this great company of Better Wealth before it was cool to be on the internet and like promoting services. And then from there you got an EA, and then it was probably less than a year, maybe a year after that, where you're like, I want to go a completely different route again. And so it's just awesome to see that things can change so quickly, and you can be willing to, because when you get to a point at Better Wealth where you guys have built a pretty respectable organization, like it can be very easy to remain there and stay comfortable, but you felt called to go elsewhere. So props to you on that. I think, Dan, when you say that, just to be clear, you started your own family foundation, that was the first time that you were organizing or really finding your way through those rules and requirements and articles of incorporation and reporting requirements, right? Like, so your test was the setting up of your family foundation.
Yeah, exactly. That was I refused to do something for someone else that I haven't done for myself.
Yeah.
And that's, just the way I like to learn is like go straight into it and try and figure out all the traps. Because instead of like assuming something works, I question, how does it work, or why does it work that way? I'm like, anytime somebody tells me something, I'm like, okay, I trust you, but I'm going to verify what you said. Yep. And I do that with myself too. I'm like trying to verify what it is that I know. And it was the same thing with this of like, I've never established a nonprofit. I've never, specifically we work in the state of Delaware, and we can unpack that as to why, but the requirements for incorporating in Delaware, and then how the specific language, the IRS has specific language that they want in the articles of incorporation for a private foundation. And that's important when you apply for the tax exempt status. Mm-hmm. But then that needs to marry up to bylaws, which are very specific to nonprofits and specifically private foundations. Yeah. And like that's like the baseline. And then we get into the IRS application, and that can be a beast in its own right. But going step by step and trying to piece it all together, because like I said, there's a lot of people, they just wrap nonprofit into foundations, public charities. There's like 28 different 501Cs. So there's all kinds of different arrangements and different organizations that are set up. And so there's a lot of confusing language around how that may apply or may not apply. And just like, you put 20 CPAs in a room and you ask them to solve a problem, they'll give you 25 different ways to solve the problem. Yeah. That's kind of what I found in the foundation space too, is everyone kind of has their idea of how things should work. But at a certain point, you just get down to the brass tacks of what the IRS requires. And so that's where, when I gathered all the different books, I started piecing all the information together. And then I went out to certain attorneys and things like that to verify my understanding of how things worked, and made it, everything packaged up in such a way so that we could set up a foundation in almost in a turnkey fashion, knowing that there's a lot of flexibility within that, because you, as the person that forms the foundation, you have a lot of control over the variables of who's on the board. Do you have an advisory role? Do you have a junior board? Do you have involve your family? All that kind of stuff.
Yeah. So take us through what a family foundation is, because I'm sure you said there's only 100,000 or some odd foundations set up. So people are probably unfamiliar with this. What is a family foundation? Why is it attractive? What are some of the benefits? What got you started here?
Yeah, so the private foundation, I like to keep it as simple as possible, is we're essentially setting up your personal charity. It's a non-stock exempt corporation. And so it is completely separate from your personal estate. I like to think of it now as your charitable estate. But it's just like you would give to the Red Cross. Instead, it would be the McCormick Family Foundation. And so it's an entity that you sit on the board, or you and your wife sit on the board, and you contribute cash or assets to that. And then ideally you grow those cash or assets now in a tax exempt environment, because you get the 501c3 status, which means that you are exempt from federal income tax. You actually get what's called the IRS determination letter. It's the best letter you'll ever receive from the IRS. It quite literally states, "We are pleased to inform you that you are exempt from federal income tax under code section 501c3.
That's great.
And so that's your permission slip to go invest the assets of the foundation, and ideally get a return from that. And in my opinion, give from that investment income to other charities, whether that's church, whether that's the Red Cross, whether that's Wounded Warriors, whether that's any initiative that you care about. But the premise of the foundation is that it unlocks other opportunities that you may not have had just by giving personally. So there are a lot of limitations within the foundation, but there's also a lot of permission slips. And one of those limitations is how much you can give to the foundation. And so public charities, right now, you can give up to 60% of your gross income in cash and up to 30% in other assets. Whereas a private foundation is reduced to 30% of cash and 20% for assets. And so what that means is if somebody's making $1 million gross income, they could give up to $300,000 in cash to their foundation, and that would reduce their taxable income to $700,000.
Yeah.
Now, if they gave $400,000, that $300,000 would still be reduced this year, and then an additional $100,000 would carry forward the next year, and there's up to a 5-year carry forward in that. But it's not an aggregate, meaning you could give up to 20% in assets and an additional 10% in cash, or 15 and 15. And you can also combine private foundation contributions with public charity contributions. So if you gave up to 30% in cash, you could technically give up to an additional 30% to public charities.
Okay. And is it the family, like you can't do 30% to one family foundation and 30% to another family foundation?
No,
right?
it's in total. So it's based on, it all flows down to your personal tax return. So it's all based on your personal total of how much you gave, regardless of what organizations that you gave them to.
Right. Okay. So basically you can get a tax deduction of up to 30% of your AGI in a year, give it to your personal charity, and then that charity, which you're operating, can invest and start to generate returns so that you have what was a lump sum is now being compounded upon, and then you continue to give out of that to organizations that you choose. Correct?
Correct.
Yeah.
Yeah. So I think that as, like, if you gave $10,000 a year to your church and you're doing that year in, year out, but we can just reverse engineer what would it take for the foundation to be able to give that to the church. Right. So at a 7 or 8% rate of return, we would need about $150,000 in the foundation to be able to produce that in a sustainable fashion. So if we've now have 150,000 and we're kicking off 10,000 each year, anytime you add more dollars to your foundation or more assets to your foundation, you're actually going to grow your impact over time.
Right.
So now you have 175,000 and that's kicking off, $11,000 and then $12,000 and then $20,000. And that's the whole premise is, if you look at the biggest foundations, they've been compounding over 50, 60, 70, 80 years, sometimes over 100 years. Some of the earliest foundations were established before the tax code was even enacted. And then it was a number of years before there were charitable contributions within the tax code. So they've been in this tax exempt environment for such a long time that they're producing these huge returns in a tax advantaged way and continuing to create an impact without any additional dollars into the system. And so I recently heard this definition of foundation is basically a boutique investment firm with charitable dividends. Because that's really what it is you're investing those dollars ideally, and then giving from the dividends or the growth of that. Then we start bringing in successorship and, whether kids or future kids take over the board. Like, I love to ask the question of, like, what does the next 100 years of your family look like? Right. Because we can actually have that conversation within the context of a foundation of, you may start it, your kids may take over it, your grandkids may take over it from them, and you can have them all be involved in some form or fashion, however you see fit. And coming back to those contributions, one of the greatest assets to contribute is appreciated securities. And the reason for that is you basically get a triple benefit. And the reason I say that is you get a fair market value deduction. So if I bought, really hot stock right now because it's been growing like crazy, if you bought it at 10 and it grew to 100 and you contributed that stock to your foundation, you would get a $100 deduction. So a fair market value deduction. You would avoid the capital gains tax that you would have paid if you sold it. So you would have had a $90 gain on that stock. And the foundation still has the asset or the cash from the liquidation for its ability to go reinvest if you so choose. Wow. And so that's where you'll see the biggest foundations are built off of publicly traded securities because of that.
Right. And it's by owners of those publicly traded companies, right? Like, I think in the video that I saw you talking about it, Bill and Melinda Gates Foundation is one that we hear about often. Like, they're giving a certain amount of money to, the organizations in Africa that are helping fight malaria or something like that. But why is it attractive to the Bill and Melinda Gateses or even the Dan Kaminskis? I mean, my skeptical mind is like, okay, where's the catch? Because they don't want to give all their money away to charity. They definitely still want to hold on to it. So what's in it for them? I think I know a couple of them, but the listener is probably brand new to this. This is their first time they're hearing about it. So what can you do as the owner of a private family foundation outside of just giving money away, if anything?
Yeah. So unfortunately, the biggest ones, there's a lot of negative aspects that occur just because there's a lot of control that can come from managing huge endowments like that and being able to, they are doing a lot of great good, but there's also some other aspects that, we won't get into here. But one of the things that caught my eye was, if you go look at the Forbes 400 list, it's the wealthiest families in the country. 83% of those families have a private family foundation.
Wow.
So my mind goes to why? And the answer is because right now donor advised funds are really hot. And last 10, 15 years, donor advised funds have taken off like wildfire. And that's because the custodians like Fidelity and Schwab and Vanguard have realized, like, hey, we can tell people they're being charitable and they get to maintain the assets and still collect fees on them and all that kind of stuff. But the reason all these families have a private foundation is because of legal control, which direct contrast to the donor advised fund is, as the name is implied, you get to advise, but you don't have legal control over. Right. Whereas you at the foundation do have legal control over it, no ownership, because once assets are given, it's irrevocably given. Same is true with the donor advised fund, but you have legal control over that. But then second, you have investment flexibility. Whereas with a donor advised fund, you don't have investment flexibility. And what I mean by that is you can basically invest in anything that creates a passive income source. So stocks, bonds, mutual funds, cryptocurrency, real estate, private equity, hedge funds, precious metals, you name it. They even, like you mentioned, the Bill and Melinda Gates, they invest in swap funds and mortgage loans and all kinds of stuff because, as a prudent investor, they have really, fancy investment teams and they do all kinds of diversified portfolios and things like that. But that's the main premise. So then if we come down from the multi-hundred millionaires and billionaires, why would people like us be interested in doing something like this? It's the same premise of, I want to be able to control and direct my giving, but also control the investment parameters of it. But then past that, some of the things that you can do with a foundation that you can't do personally would be like grants to individuals or the like international giving. I work with clients that are giving multiple six figures a year overseas, and they're not doing it before having a foundation. They weren't getting a tax deduction for doing so. By simply putting the foundation in place, they are able to make that tax deductible because they get the deduction from giving to their foundation, and then the foundation gives to the overseas charities.
Yeah.
And there's direct charitable activities. So, closer like November, December timeframe, food, clothing, and shelter is really popular, especially with the northern climates. And so being able to give that kind of stuff out where you can quite literally go to the store and buy that stuff and hand it out, and that be a charitable gift on behalf of the foundation, where if you did that personally, you wouldn't be able to do that. Now, in certain cases, people are like, well, that's small potatoes and things like that. But there's some people out there that do that at a large scale and can be very beneficial, not just to the people that they're giving to, but for them from a tax standpoint. But then direct to individuals would be things like scholarships, which are really popular. Hardship assistance. So somebody that has, financial woes, or a spouse suddenly dies or something like that. And then disaster relief. So what's just happened, the Palisade fires, or down here in Orlando or in Florida, every time a hurricane comes through and there's a disaster zone, like a foundation can go and support individuals directly instead of having to go through a charity like the Red Cross.
So you mentioned like grants and scholarships. If I wanted to set up a McCormick Private Family Foundation, McCormick Family Foundation, and then we'll see where college is in 18 years, but I wanted to send my son to college, could I write a scholarship to him out of my family foundation, and that's totally doable? Or does it have to be a certain type of individual that you're writing a scholarship, or to a certain organization that?
Yeah, it's a good question. So in context of the family foundation, one of the things we need to avoid is self-dealing. So this will be a good segue into the things we need to avoid with the foundation would be self-dealing, jeopardizing investments, taxable expenditures, and excess business holdings. Starting with self-dealing, as the name implies, you can't really have the foundation be your personal piggy bank or personally benefit you and your family. That doesn't mean you won't benefit, or there aren't ways to benefit from having a foundation. But there's a specific clause in articles that say there's no private inurements, meaning that you or your family and family members cannot benefit from having the foundation. One of those things, the hallmark of self-dealing, would be exactly what you're describing, saying, hey, I want our child to go to this school, and we provide scholarship for doing so. When it comes to scholarships, the IRS wants you to be unbiased in how you select the recipients. So, they don't want it to be your friends or family or relatives, things like that. They want you to select what they consider a charitable class, but you have a lot of purview to that because charitable is a very broad category. And there's really two ways to do that: is have your foundation do it, which is the harder way, because then you need to have a selection committee and have to put in all the criteria and have people apply and filter all the applications and all that kind of stuff. My preferred method is to go to the organization that you want the scholarships to be used at, and because they have entire teams of people that deal with this stuff on a daily basis, and say, hey, we want to endow the scholarship fund for whatever dollar amount and whatever, however many scholarships. And you just state, we want it to go to the people that fit this criteria for this purpose, so on and so forth. And then they go through that process and take care of the administrative burden.
That's so interesting, because you mentioned at one point that it's like when you buy a car, or you have a car that you want to buy and you start seeing that car everywhere. I think people call that the reticular activating system or something like that. But when I was in college, I worked in the Office of Institutional Advancement, and I got to see some of these big dollar amounts being given out in scholarships and grants. And I'd be willing to bet the majority of them were coming from something like a family foundation. And the same thing goes, like if you go to the listener, or Dan, you might even be able to vouch for this. Like if you go to somewhere where their donations are accepted. I was at like a nonprofit retreat center recently, and I saw on the walls, like this was given through like the Wells Family Foundation. And it's like, oh, well, that's Dan's line of work. That's what he's doing. And he's looking to to bring that to others. So it's just so interesting. But it's also kind of a hidden gem. Like am I getting that number right? Did you say only 100,000 family foundations are set up?
That's correct.
And 87% of the Forbes 400 runs them. My question to you, Dan, is what's going on with the other 13%? I think those guys need a service provider like yourself.
Well, it's in a certain sense, foundations were almost like the good old boys club, where you could only have access to it if you knew a person or knew a family office or somebody that would be willing to provide the services of it, which is kind of strange to me, because if you even drill into those 100,000, like close to 70% of them have assets of less than $1 million.
Wow.
So just like most things when it comes to wealth, there's a lot of concentration of wealth, because right now I think private foundations specifically in total have about $1.7 trillion in assets. So 100,000 foundations, 1.7 trillion in assets. There's a lot going on there. Knowing that 70% of them have less than $1 million. So there's a lot of concentration of wealth of the biggest foundations, and they're only continue to get bigger because they only have to give 5% of the net assets to their foundation on an annual basis. So that's one of the potential downsides for people, is the IRS, for having the benefits of a private foundation, which quite literally Congress stated that having a private foundation is a privilege. And for that privilege, there are some rules that you need to follow. One of them is distributing 5% of the foundation assets on an annual basis. So if a foundation had $100,000, they would want you to give away or spend $5,000 each year, and that would reduce if there were no other assets brought in, or if the investments didn't perform well, but it would increase as more money came in. But even if you have $1 billion foundation, it's likely that the people that are investing the funds are going to be able to grow it faster than 5%. Some of these foundations are growing at 15, 20% year over year. And so they're satisfying their 5% requirement, but then they're continuing to grow on top of that, plus whatever contributions came in. So we touched on self-dealing. The next would be taxable expenditures. So this is something to avoid. And really, when it comes to taxable expenditures, it's basically don't give to any one political party, is what their IRS is saying. You can give to organizations that like promote voter registration and going to vote, but they don't want you to specifically give to any one party.
Interesting. These guys can do that out of their own piggy bank. It's no secret that like a lot of Hollywood elites were supporting one political party in this past election.
Yeah, and they would be doing that out of either their personal bank accounts or business accounts.
Okay, interesting. All right, so there's no personal dealing. The expenditures you can't give, and that they state that outright. It's like that's the only thing that the political.
So the overall clause is using dollars for non-charitable purposes. Okay. But the most common trap is giving to political organizations.
Right. Yeah, interesting.
So you have self-dealing, you have taxable expenditures, excess business holdings. So basically what this means is the foundation can't compete with for-profit businesses because it would have an advantage because of the tax-exempt status. Okay. So a foundation, as I stated previously, needs to stick into the passive income sources. Mm-hmm. So it can actually own up to 20% of a business, sometimes up to 30% in certain arrangements. But that's an aggregate. So like if I had my foundation own a percentage of my business, we would be above that because I would have 80% ownership and the foundation would have 20% ownership. Whichever way I work it, it doesn't work because the overall ownership would be more than 20%.
Okay. Like it combines your personal holding with the foundation's.
Exactly.
Okay, gotcha.
Now, in certain cases, closely held businesses, C corporations, things like that have a lot of investors. There are instances where a foundation can own shares of those businesses and that money flows directly. This happens sometimes when people are going to sell a business. Is prior to the sale, they establish a foundation, they donate shares to the foundation, and then upon the sale, they get to avoid the capital gains tax because the income goes directly to the foundation and it's tax exempt within there. Mm-hmm. Other cases would be like if somebody died and upon bequest, they give their business to a foundation. You can do that, but the foundation has to divest its interest within a 5-year period from there. But there's a lot of different scenarios that you can make something like that work.
Yeah, interesting. But it seems that you have to have a desire to be philanthropic for this to work, which I think a lot of people do, especially when you develop a certain amount of wealth. Like there's only so much you can do with it. And they're like, okay, we can give some away and avoid taxes, right? Like most people, there's no way to put money into a private family foundation and then feed yourself off of it. It's got to have a... That's what you're saying.
So yes, asterisk. Yeah. So when somebody comes to me and they have a charitable intent, like we can make a lot of stuff work. Yeah, we can justify a lot as long as you have a charitable intent. It's the people that come to me and say, hey, I want to save money on taxes. The conversation almost always goes wrong because they're constantly trying to figure out how this benefits them. And that's not the point.
Right.
The point is to be charitable.
Right.
And then there are fringe benefits within that. One of the most common questions is, can I pay family members to be, run the foundation or be part of the foundation?
Mm-hmm.
When I first got started in this, I was getting my hair cut, and I was just telling the person that was cutting my hair what I do. And they said, oh, that's funny. The person with the chair next to us, that cuts hair, she is an employee of her parents' family foundation, and they pay health insurance. And because as a 1099 contractor, she didn't have access to health insurance. So they hired her within the family foundation, paid her salary, and paid for her health insurance. And you can absolutely do that. Now, just like with S-Corp compensation, the compensation needs to be reasonable, and they actually need to do something.
Yeah.
I'm not sure that was the case in that scenario, but I'm not their accountant.
Right.
But the reasonableness with a salary within the foundation is based on foundations of similar size.
Okay.
So if we scale up real big, we go look at the Rockefeller Foundation, the Ford Foundation, they're managing $25 billion plus, endowments.
Crazy.
Their executives, which there's a lot of them, are getting $1 to $1.5 million annual salaries.
Oh man.
And on top of, or in addition to, fringe benefits and big compensation, other packages and all this stuff.
Yeah.
If we scale down, my personal preference is not to pay salaries until the assets of the foundation are north of $1 million.
Mm-hmm.
And the reason for that is because typically when people think of a salary, they're going to say $40,000, $50,000. And if we're at $1 million, we're already just giving, we're expending 4 to 5% of the foundation's net assets just in salary. And if that's the case, we would satisfy the 5% requirement and never actually have to be charitable.
Wow.
And there's a lot of rhetoric going on right now, of specifically within private foundations, of the general public seems to think that that's all private foundations are meant for, is to funnel assets into, pay family members, and then never actually give dollars to any other organization, which an independent organization did a study and found that like less than 10% of foundations operate that way.
Okay. Well, that's good. That's good to hear. So when I first heard about this, we've recommended things like charitable remainder trust to certain clients who might have big capital gains coming up, and they want to do something similar where you can live off of some, but you can give some away. So how does this compare? If you know, that's great. If not, just let me know. But how does this compare to like a charitable remainder trust where you can similarly put money in and avoid some of the taxes that might come as a result of a transaction and still live off of some of it as well?
Yeah. So in certain cases, like if we go up to the 30,000 foot view, your money can go, or your assets can go 3 places. It's either going to go to your heirs, it's going to go to a charity of your choice, or it's going to go to the government in the form of taxation.
Right.
So at a certain point, in most cases, the people that I work with, they've gotten to the point where they either decided that they don't want their kids to have, their assets, or they've already apportioned an amount for their heirs. So if that's the case, we take the heirs out of the equation, then we just have the tax from the government or a charity of your choice, which just happens to be your personal private foundation. Those families are going to choose their charity every single time.
Right.
And in those cases where you're describing, if somebody needs the income from a charitable remainder trust, a foundation is probably not going to be a good opportunity. Okay. Now, to caveat that, a charitable trust may be better from maneuvering the asset in and being able to control those funds in a little bit different way than you would within the foundation. And it really just comes down to the deductibility limits. And I've seen cases where the beneficiary of the charitable trust is actually the private foundation. So, there's avenues there as well. And there's no right or wrong way. The charitable trust is probably going to be cheaper, especially if you don't have the intention of the generational aspects of the private foundation. And it can happen in certain cases a lot faster, especially if you have a sale that's like needs to happen immediately.
Yeah.
You just draft everything and move on your way. But in a lot of cases, especially with the really big families, I'm talking like north of 100 million, they don't really care about the tax benefits per se. They care about the legacy aspects because they have the tax benefits taken care of in a lot of different ways. Yeah. And they don't necessarily have the income to be able to get enough, benefit anyways. Right. If you sell if you're making even $1 million a year and you sell your business for 100 million, there's just no way that you could get enough money in based on the deductibility limits to have a tax benefit. But what we're talking about there is we're getting into estate tax issues. And that's where something like the foundation comes into play. Is if you look at a family that starts a foundation versus one that doesn't, and then waits, 30 years later, the net assets within the family is under control is almost double, if not more than double, depending on investment returns for the family that started 30 years sooner versus the one that didn't. And the reason for that is a couple fold. One is they're getting a tax deduction over time as they contribute assets to the foundation. Two, they're growing those assets within a tax exempt environment. And then three, eventually they're avoiding the estate tax on anything above the exemption limits.
Right. Wow.
So it can get really, really powerful. And in most cases, I'm operating in the lower realms of dollar amounts, like that less than million threshold. But like with a lot of things, it gets really good once you have more assets into the system, because the benefits start compounding.
Yeah, which is what you're saying, right? If you get it in early, then by the time it's compounded and it's doubled or tripled, you don't have to worry about some of these other complexities that come up when you do have that and don't have a foundation set up. So basically, and you kind of answered it, right? It clicked in my head right as you started to answer it. Like the charitable remainder trust, you don't keep the money after you pass on. Like that goes all of it goes to the charity. Whereas if it's a foundation, it can continue to reap returns and rewards, and whoever's in charge of it then gets to say, and that doesn't have to be your heirs if you're afraid of giving that.
Yeah, exactly. In certain cases, so earlier we talked about Delaware. The reason we set up foundations in Delaware is because one of the things that they allow is solo board members, where other states don't allow that. And that could be problematic for somebody who doesn't have any family. I do work with quite a few people that they want to be charitable, so they have zero family members.
Wow.
And so that can be really beneficial. They also don't require or don't have age requirements on board members. So some people want their less than 18-year-old kids to be on the board and participate, and they can do that in the state of Delaware.
Wow.
And so that too is like, there's a lot of different levers that you can pull and things that you can do where, as the name implies, family is involving your family in that. Now, one of the aspects that people talk about a lot is doing an annual family retreat or annual family meeting. And that's really where this all comes together, is bringing structure to the conversations like, what is our family legacy? What is our family mission statement? What are our family values? What do we want successorship and stewardship of the family resources to look like? And for the matriarch and patriarch, being able to involve, G1, G2, G3 in the conversation, meaning the next generations over time, so that they feel confident that the family members are equipped to be able to manage those resources in an effective manner. That's where all the fun stuff, like all the magic happens, is in those family meetings. And if the family is geographically diverse, it is reasonable for the foundation to pay for the travel expenses to come to a centralized location and have that family meeting, whether it's at a resort or something like that.
Wow.
And again, as long as it's not extravagant and is reasonable, you can absolutely do that.
Yeah. Man, that's exciting. As somebody who lives in Minnesota with family in New England, I'm like, well, that could be useful. We try to make everything a business meeting, and all our meetings are in areas that our family is involved, but the Family Foundation makes it a little more. Well, and then you get the charity part on top of it.
Exactly. And it becomes a charitable business, essentially.
Yeah.
Where it's a low stakes environment to have those same conversations of planning for the next year. Who did we give to last year? How much did we give? How did the investments perform? Do we want to reallocate things? Do we want to give a little bit differently? Are there different initiatives we want to give to? David Green, the founder and CEO of Hobby Lobby, he calls it the adventure of philanthropy, because quite literally his family has traveled across the world, to see the effect of their giving and to promote their giving, and they're giving huge dollar amounts and they're able to. But he said that's the most fulfilling part of all the things that he's done, is on a monthly basis, because they're giving so much. The family gets together now, 3 generations, and there are probably 4 now at this point.
Yeah.
And they get to deliberate on who they're giving to, why they're giving to them, and all that kind of stuff. So it's can be really powerful.
Man, that's so beautiful. I think before we close, Dan, if you will, just talk about some of the cautions that people should exercise. Because me personally, the reason I wanted to reach out is because there's been people on social media that have said they do 3 or 4 different things. And one of them they mentioned is they set up a private family foundation. And you hear that and you're like, oh, I need to get a private family foundation. It's just that easy and I'll save on tax. So, but to your point, it's very complex. It's not as easy as just filing something or putting something online. Like, you need an expert like yourself who's been through this and done this and is certified and specialized in it. So what are some of the things that we should be aware of before taking this step? Even maybe like things that we should be thinking about, whether it's the best thing for us.
Yeah, I'd actually like to make a distinction. I heard this recently from a charitable advisor that said, experts go up on stage and tell you what you should do and then leave it at that. Advisors can tell you what to do and actually help you accomplish that. Wow. And so I'd actually prefer to be considered a charitable advisor, because what you're talking about is those people on social media are, quote, experts that say, hey, you can do all these things. And I know specifically there's one that says protect 30% of your income with a private foundation. And while that's true, and there's a lot of half truths, is I guess the best way to describe it. There's, pay your family a salary, put a deferred compensation plan in play, do all these things, and then it falls flat on the actual fulfillment. And so the traps of the foundation have to do with those compliance requirements of there are potential excise taxes that are problematic. There is a 1.39% excise tax on net investment income. So what that means is if the foundation grew by $100,000, they would have to pay $1,400 in excise tax, and that's on a quarterly basis, just like estimated tax payments and things like that.
But you're going to pay regardless, right? If it's because isn't that net investment income tax? You're, I guess, over a certain income level.
Well, it's specific to the foundation.
Okay, all right.
But there's a lot of random stuff that even if you look at an accountant, because one of the other things people ask all the time is like, can I just have my accountant do the tax return? And the answer is yes. However, a good chunk of our business comes from existing foundations because their current accountant doesn't know how to do the 990PF. Yeah. And in a lot of cases, they do it wrong. Actually, Moss Adams, one of the biggest law firms in the country, they did an analysis, and I think it was 83% of foundation audits end up in an increase in excise tax simply because the tax returns are being done wrong. Okay. And so if we look at the numbers, 100,000 foundations, there's like 850,000 tax preparers. So just on a straight line basis, I think like it's a 13% chance that your accountant has ever even seen a 990PF. Right. And it's probably even way less of the amounts that have actually filed one. And so that's a trap too, is like just setting it up and not filing a return can be majorly problematic because not only would excise taxes be hit on the foundation itself, but at a certain point of enough non-compliance, it would actually hit the foundation managers and they would have to pay excise taxes too. And so suddenly this thing that was great in giving you tax benefits and it's supposed to be charitable turns into this nightmare where you're having to pay more money out of pocket just to cover the excise taxes that came in play because you didn't know what you didn't know. Right. And so there's those aspects, but then there are costs involved. There's certain people that, bless their heart, they want to be charitable, but there's probably better ways for them to be charitable without having extra expenditure. Cause it's just, there's certain levels where it's like, don't necessarily want you to be, you're giving, let's just say $25,000 a year, and now it's costing you money to give $25,000 a year. Right. Like that's not benefiting anybody. We're actually going the wrong direction. Yeah. And so at a pure minimum, I would consider the $40,000 to $50,000 range on an annual basis to like meeting contributions to the foundation, where this starts to really make sense. Okay. And the main reason for that is because as the standard deduction is currently almost $30,000, if it isn't $30,000 for 2025, 93% of charitable contributions are non-tax deductible because 93% of people take the standard deduction. So, that is as of 2017, and that's of course going to change potentially soon. And so that's why I say that is if you're giving 20 grand a year, I applaud you. Yeah. And however, in a lot of cases, that's not being tax deductible for you unless you have other ways to itemize. Right. And so it becomes kind of that metric of what point does it make sense, because there is cost and things like that. In a lot of cases, we're working with people that are going to have a capital gain where they have appreciated securities, they have appreciated Bitcoin, they have an appreciated property. If you're out on the West Coast and in the 70s, you bought a property for 100 grand and now it's worth 1.5 or 2, and you don't want to pay the capital gains tax, it could be a great asset to contribute to the foundation and sell within the foundation. So you avoid all that capital gains tax, sale of a business, that kind of stuff. There's that proverbial about $1 million mark is where people tend to land is, you get $1 million into the foundation, it grows at 7 to 8%. They want you to give 5%. So you're growing by, 30 to 40,000 on an annual basis, plus giving away 50,000 a year. Like that's a really good, ballpark for, you can do a lot of good while growing that over time.
Absolutely. Man, that's so good. We didn't really even touch upon the impact of real estate. We might have to have you on another episode. Maybe we can unpack one of these. We could unpack the Bill and Melinda Gates Foundation and see what they're doing with their money.
I don't know if I want to go that route. Yeah. I can't help myself though. So there's, you have the Rockefeller Foundation. Yeah. Actually, let's just back up. All right. A lot of the biggest foundations have been set up to change public perception of the person who established it. So you look at John D. Rockefeller back in the late 1800s, early 1900s, he was probably the most hated man in the world because of his oil tycoon and everything. So what does he do? He spins up the Rockefeller Foundation, and suddenly they shift the public persona or public perception of who John Rockefeller is, and because he's doing all this good now. And he's also spun up the Rockefeller Medical Institute. Well, the Rockefeller Medical Institute developed a lot of, probably can't see on YouTube, medicine. And turns out that you can control populations if you provide their medications and things like that. And so they realized, over a long period of time and a lot of government control and things like that, where they can use this charitable vehicle to do a lot of, good and not so good.
Yeah.
Now we fast forward, the next century, Bill Gates with Microsoft. Mm-hmm. A lot of antitrust, a lot of monopoly stuff going on. Bill's bad person. Yeah. What does he do? He establishes the Bill and Melinda Gates Foundation, grows into this giant thing, and they're doing all kinds of very similar things to what John D. Rockefeller did. Wow. Look at Mark Zuckerberg. A lot of, Facebook's bad, antitrust, privacy, all this stuff, establishes the Chan Zuckerberg Initiative. Hmm. Elon Musk, bad guy. The Musk Foundation. It's like, it goes on and on and on. Now, to their credit, they are being charitable. So like they are giving dollars away. It just so happens to be their charity.
Right. Oh man. Reminds me of that good book that I read once in a while where it says that there's nothing new under the sun. And that's right. We have it here. So Dan, man, I love you. I appreciate you coming on. Where can people get a hold of you? Where can people reach out? Because I'm sure there's going to be people that are interested in this and want that advisor in their corner to help them out.
Yeah. So the easiest place is foundationlaunch.com. And my whole goal is to educate and support people so they can make the best decision. And whether that is just having a conversation of where they're at, that's what I do a lot is I start with what's your philanthropic vision of like, what do you want to accomplish? Because I believe if you gave somebody $100 million check at a certain point, at a certain dollar amount, pick a number, someone wants, they will be charitable. Like right. I just think it's an innate thing that people want to be charitable. They just sometimes don't necessarily think they have the resources to do it. Right. So that's what I try to extract first. And then from there, it's kind of the decision matrix of what makes the most sense. Is it continuing to give the way you currently are? Is it a donor advised fund? Is it a private foundation? Is it charitable trust? Is it something completely different?
Yeah.
But even though all I do is private foundations, a lot of what I do is charitable advisement of like what makes the most sense in the context of what you want to do. So foundationlaunch.com for that. There's a blog, a lot of information there. I'm starting my a YouTube channel, so hopefully getting some more education out.
Yeah.
And then email is dan@foundationlaunch.com.
Awesome, man. Well, thank you for coming on and sharing your wisdom. You are a light, and you said your goal is to educate people, and you surely did that today. So appreciate you. And yeah, for the listeners, if you got any sort of value, if you have interest in this, feel free to reach out to Dan. He's very generous with his time and with his money, clearly. And so we appreciate you, Dan. And until next time, listeners, keep moving forward, and God bless you all.